Ryan, I got to say I'm bearish. Everybody is predicting a recession. And while that feels like that means everybody's going to be wrong, all the statistics we have, our internal gauges are all pointing straight down. They're all red. It looks like it's going to be a tough year. Now, the second half of the year, I don't know, but the beginning of 23, I think you've got to be defensive for sure.
So you don't believe then that a recession or a slight recession, whatever it may be, a slowdown, whatever you want to call it, has already been priced into the American stock market?
No, I don't believe it has. I mean, we have adjusted to these what I consider climbing interest rates. It's good to see inflation slow, but goodness, 6% on an annual basis is still a very fast pace, much higher than the Fed wants, which means they're going to raise rates. And obviously, everybody's looking into 23 and waiting for that word pause. I don't think they should. I don't think they will. They're data dependent. The data still shows that we have a steady inflation. And I think that the markets have been having these nice little bear market rallies, but we're overbought in this condition. And I think that market's going to sell off as we get into 23.
Wow. You know, you sounded kind of like, obviously you're a super long buy and hold investor, but you know, you watch the markets every day. I'm sure you have to. You're overseeing about $300 billion in teachers and educators' money. You want to make sure you're a good shepherd of that. I know you're not a day-to-day guy, Chris, but I mean, the market's ripped in the morning on the CPI data on Tuesday, only to come back down to earth. Is that kind of what you're talking about, these short-term bear market rallies, but the overall setup may be a little more negative?
Well, even longer term, Brian, if you look at how the markets have traded since June 30, which is our fiscal year end, we're actually up on this fiscal year so far. And I've told the board I don't think that's going to hold. Corporate earnings have got to be hurt by these higher interest rates. We're going to see some more squeezes as we get into 23. People who can't adjust to these, rates going up very rapidly. And I think they're going to continue to climb. So it's going to put pressure on balance sheets. We're already hearing about, the labor market is in a very strange position where small business can't find workers, but then, the tech firms are laying off and other people are cutting back. So everybody thinks it's a recession. The question is, what's the adjective in front of that? Is it going to be mild or severe? That's tough to predict at this point.
And it might, to your point, Chris, it might ultimately be regional. We might have a severe recession somewhere and a more mild recession elsewhere, as we've seen in the past, particularly in housing. But your job is to, protect, grow, but more importantly, to protect the assets of your educator partners at CalSTRS. So if we're looking at a pretty tough year for equities, maybe a tough year for bonds, give us your view, probably a tough year for real estate and private equity, how do you protect those assets, and what could be a tough year for a lot of things?
Well, number one, Brian, you hit it on the head. We're long term. So we diversify the assets. We put our eggs in multiple baskets. And you may be right. If it's stagflation, then it's going to be bad for almost every asset class. But so far, private equity has held in there. Real estate just hasn't transacted. Obviously, with higher interest rates, real estate should have some price compression, but we really haven't seen it. People that want to pull their money out, there's not enough buyers around to pick up the properties, and prices haven't readjusted. So we're going to diversify the portfolio. We're defensive. You're right. We don't try and time this market, but we can lean the portfolio defensive or aggressive, depending on our outlook. And we're going to be in other assets that pay cash flow. That's going to be the key, I think, in 2023 is dividends and nice steady cash flow.
Where do you find those? Public equities? Because I do know that you are about 5% under your desired allocation to equities.
Yeah, no, exactly. That's what I mean by being defensive in this kind of a market. We're finding it and you're seeing a lot of institutional investors go into private debt. Retail investors just can't go there. And that's really a change that we saw after 08 due to banks getting out of that business. There's still infrastructure investments, and we have many that have a nice steady cash flow in them. So I think there are going to be opportunities. And as you brought up in fixed income, Fixed income's already had a really tough 22. Rates are going to go higher, but you're already starting to see if you can be a buy and hold investor in fixed income, you're seeing some nice return on your assets.
When you say fixed income, are you speaking about medium and long-term U.S. Treasuries or more corporate debt?
I'm a bit worried about sovereign debt in here. The U.S. is set up for another problem in Washington where they'll probably use the debt ceiling as a bargaining chip, and that's never good for sovereign credits in the USA and around the world. But I think in some good corporate names, I think there's opportunity in, as I said, some of the asset-backed areas, things that we think of as infrastructure, leases and steady payments provide opportunities, but you've got to do your homework. This is a time period where some people are really going to struggle as rates go higher and not be able to meet their debt service. So the key is doing your credit.
I'm going to ask you one quick final question. So if you have to own equities and you have to own everything, do you stick with the Apples, the Microsoft, the J&Js, and dare I say even some of the big oil companies of the world?
Well, Brian, we don't buy individual industries. We buy the whole market. So I think the USA is of all the global markets, the USA is in better shape. There are parts of Europe that might be interesting, but Europe as a whole, the EU is still going to suffer. The UK is just kind of a mess right now. Yep. Asia, I can't say Japan's going to have any economic growth. Good companies, but very slow growth. So it's very tough around the world. Emerging markets are cheap. They've been cheap for 2 years. So within the equity framework, it's really tough to find anything that is super attractive right now. But I think blue chips in the USA and blue chips global companies are going to continue at least to hold their value and be worthwhile. And that's being defensive in this kind of a market.